welcome. I'm Sam Kilmer, Senior Director, lead our fintech advisory practice at Cornerstone Advisors. And I'm joined by my co-host and world famous marketer in chief and our research director, Ron Shevlin. And we today, in addition to both of the Shannon Crandalls, one who has a bar and one who has an interesting bookshelf, we are joined by our two guests today. Kathleen Craig, who's the founder and CEO of Plinqit. And I think also, I get this right, Kathleen, you're on the board of Association for Financial Technology and also a former banker from, I was a chief digital officer before we knew what a chief experience officer was. I think you were a chief experience officer and probably a few other titles in there, but hope I didn't completely botch your background, but welcome to the FinTech Hustle.
Thank you for having me. You didn't botch it. You just gave me a promotion. I wasn't quite a chief at the bank, but I'll take it.
Right on. Well, we're giving away, Ron and I are giving away promotions gleefully today, so we'll go ahead and say that that's in after the fact. And then our other guest today, the founder and chief strategy and sales officer of Alkami, Stephen Bohanon. Stephen, welcome.
Hey, thank you. I appreciate that. I was also technically a former banker. I think my first job kind of out of high school, I worked for Midland Mortgage Company owned by MidFirst Bank, and I was doing streamlined refinances. So I was dialing for dollars and processing those refinances. So I think technically that made me a banker. I'm not sure, but.
Well, yeah, I think it does. And I also see in there somewhere, not that we have to jump through acronyms and all kinds of interesting providers, but you were what commercial lending too, right? AFS.
AFS was actually payment processing. There was another AFS that was the former Littlewood chain. I was part of that one. But I worked for a company called Custom Credit Systems, later bought by Misys. But they did commercial lending automation software. Yeah.
And you were in that famous run at Metavante too. I mean, Metavante had a real run on the market there way back when, and you were part of that. And I think what first takeaway from FinTech Hustle that I've already noted is if you name your company an acronym like AFS, and please do not send me hate mail or doggy bags on the doorstep. But if you use an acronym that other people have used, it could be a problem for your brand. That's
sure.
My takeaway.
Mainly because people thought we were the American Floral Service, which was the number one.
Right.
So Sam, this is your advice from the guy from Cornerstone, which is how many Cornerstone advisors are there? I think we ought to move to the next topic as quick as we can here.
Sure. You're right. I mean, let's throw ourselves under the bus here as much as anything else. So, but yeah, seriously, welcome, guys. Appreciate you taking some time to chat with us. We're going to do our best to over the next 30 or 40 minutes or so to just kind of talk about what's going on. That was the first thing. We always like to talk about whenever Ron and I kick these things off is just to say, what are you guys seeing out there that's working and not working in the big land of fintech, bank tech, banking, all of that big sandbox that is all jumbled up, and banks are becoming fintechs are becoming banks. Everybody's a provider. What are you guys seeing that's Let's just start with what's working well out there. What do you see working well, and then we'll come back to what do you see challenged out there. Kathleen, do you want any thoughts on what's working out there in fintech land?
Yeah, sure. I think there are some banks and credit unions now that are partnering with earlier stage fintechs, which is exciting. I think the industry is shifting more to partnership, right, and B2B versus everyone wanting fintechs to make the Uber or Amazon of banking, right? Feel folks have finally settled in that it's highly regulated and partnerships the way. I do think, though, on the what's not working, though, I think a lot of us former bankers, want to be innovative, and we say, and we take the demos and we go to the accelerators and all of these things, but we're not quite ready to buy. We haven't figured out how to truly partner with early stage startups, which is holding back and really making, a struggle for fintechs, because you need that first 1 through 5 banks to partner with. And if you don't have that and those folks that are willing to take a risk, it makes the job as a founder really, really hard and really challenging.
Yeah.
Sure.
Stephen, any thoughts on what's
well,
what's
I think
out there, or thoughts about what Kathleen said?
Yeah, I think generally what Kathleen said, it's a great point. We recently launched a cryptocurrency product, within digital banking, and I would say that probably the 3 months, maybe 4 months leading up to us launching it, as we were building it, I probably talked to 25 to 30 separate customers. 100% of them said, "Oh yeah, we're really interested. Let us know as soon as it comes out. We're ready to roll." And then we're like, "All right, guys, it's out." And then who wants to be first? And it's crickets. And so, now there was 2 or 3 that did sign up, and the others have all said, "Yeah, when we said we're excited, we mean we're excited once a few people do it first, and then we want to do it." So I agree with Kathleen as the mismatch, almost like the eyes are bigger than your belly in some cases, where I definitely want to try it, but I'm a little bit scared, or I'm not sure how I get it to the rest of my organization or whatever. So the appetite versus the reality, probably sometimes there's a little bit of a disconnect there.
Hey, Sam, I heard a interesting story yesterday. I was talking with someone who works at one of the banking as a service platform providers. And their perspective was pretty interesting. They said, they obviously, there's not a lot of banks doing this today, but they've got a few that work with them. And they said the banks that have actually been in this longer are starting to get more conservative, moving slower, whereas some of the newer ones getting in are eager to jump in, start, getting new clients and stuff, getting into the space. So it's funny how the early innovators in banking as a service are now kind of getting mature and slowing down a little bit. The old corporate culture of, compliance first and risk first is kind of slowing them down a bit, whereas the newer ones are gung ho, let's go, let's get started, let's do all this. And, interesting sort of, I think, maturity pattern here.
Well, maybe they know something. I'm not sure. I think part of it is that obviously the new entrants, they have to do something, or else why are they relevant? So that they can't come along and just say, "Hey, by the way, we do the same thing that the old big guys do, but we just have a lot more risk and we're smaller." And they can't say that. So I think that's the way they make the splash is with their speed or their kind of attitude towards innovation and adopting it more quickly.
Well, it reminds me a little bit of, Stephen, when I was where you and Kathleen are. I was never a founder of a company, but I worked in as in an industry provider. We used to have a saying: revenue solves lots of problems. And so when you're sitting around and you're kind of established, the downside is you might not be able to move as fast, but the upside is you've got runway. And when you're young and I guess when you're young and starting out and one hesitates to use the term desperate, but let's just go for it. You don't have the revenue that solves the problem, so it's a little more creative out there. So maybe that's part of it. But I think you said something about, what was it? 100 turned into 3.
Well, yeah. As far as, it wasn't 100, it's about 30, but it was 100% of interest.
100%.
Yeah. Well, yeah. And everyone's still very interested, just don't want to be first.
Right. And that was my point, is we have the interest and we're taking the meetings with these founders, right? And we're doing the demos. Founders don't have time to demo with you if you don't know how to buy. I love you, banks. I love you. I was one of you. I support you. I build software for you. But it can be a lot of wasted energy if you can't figure out how to actually partner with a solution you're interested in.
Yeah, there's also, I think one of the limiters to getting more innovative things out there is there seems to be this fear of failure that really the mega banks don't have. I looked at, I'll just use an example because we happen to be talking about this today in another meeting, but Chase came out with their Fin product. I don't know if you remember this a few years ago. Mm-hmm. Spent like $50 million on this thing. Like it was going to be a mobile app only thing, really for Gen X or Gen Z type customers. And then I think within like 2 years they shelved it, right? And they said, yeah, it cost us $50 million, and okay. Well, now obviously $50 million to Chase is very different than $50 million to somebody else. But the point was, like, we're going to try it. And then if it doesn't work, we'll just shelve it and get rid of it. And sometimes there does tend to be this mindset in regional and community financial institutions, both credit unions and banks, like, look, we're not going to try because what if we have to pull it back? What if it doesn't work right? Then we've gone through all this stuff for nothing. And if you have that mentality, you're just naturally going to have a slower metabolism than really everything else. So I think that the idea, whether it be Plinqit or be any other thing, to say, yeah, we're going to go ahead and try it. And then we'll put it out there. We don't have to stop our whole organization in order to do it. And many times it's, let's put it out there and let's make it be self-service, and let's not, have to train all of our call center reps and all of our branch reps, all the things that you put into it to try to do everything, and be able to take chances on little things and be totally okay with it not working and then pulling the plug on it later. And you have to really have that kind of a mindset. And that's not typical. That's not a typical mindset when you think about the typical banker, right? Because the typical banker thinks like, I don't have that mindset when it comes to loans. I don't just say, well, let's approve them, and if they don't pay, no big deal. We'll just say, So this kind of actuarial kind of mindset and this kind of low risk mindset kind of creeps over into things having to do with software and technology and things as well. And I think it can really be a barrier to moving fast.
Absolutely. I think that it's budgeting season, right? So now's the time to have a risk budget for the next year, right? So if something comes along or something new like NIDIG comes and you want to give it a try, you have that ability that it didn't have to be approved 18 months ago or 12 months ago in the budgeting cycle, that you have that risk and you're like, okay, if we fail, let's fail fast, right? If it doesn't work, but let's give it a try. And I do see more and more FIs and community FIs doing this. So I'm thankful for that, but I think that we all need to figure that out a little more.
I'm trying to think, Kathleen, of I'm going to take myself back to my $2 billion bank that when I moved to Indianapolis, and I'm leading digital for $2 billion bank. They go, hey, you seem to know a lot about computers. Why don't you be our leader of digital? Okay. So I get in there and I'm thinking to myself, when am I going to go to the board and ask for my $50 million, Stephen, my $50 million fin test case at a $2 billion bank? I mean, I guess you can just scale that down and say, I'm not going to ask for 50 million, but I'm going to ask for a couple of million, or maybe 500,000, or maybe 50, or,
you can do a lot. I mean, there are fintech startups right now that you can purchase, right, for low 5 figures, right, to try. They're willing to do a proof of concept with you, right? It doesn't have, Chase has 50 million. Community FIs can have a lot smaller test budget. And again, a good example for us is Choice One Bank. Choice One Bank here in Michigan, at the time, they're much bigger now, but at the time, I think they were only around 500 million in assets. And Adam Greenland, their CTO, and I had lunch at Applebee's. I'll never forget. And I was like, hey, I have this new product. It's called Plinqit. Would you be willing to try it? We sketched it out on a napkin. And he was like, yeah, let's give it a whirl. Let's see if it works. But if he hadn't been willing to do that, and his CEO and the board hadn't been supportive of that, Plinqit would have never, gotten off the ground.
Just would have got the chicken fingers and riblet basket and gone past the fintech option there. That's it. I mean, it seems like that's where everybody gets hung up, right? Because we talk a lot about risk appetites, but don't you think it's interesting that at some point you have to make a dollar decision? Whether it's 50 million in Chase's case with Jamie Dimon, he had the currency internally to say, hey, we can take the risk, or whoever that group was. And I'm just thinking to myself, most risk appetite statements that banks and credit unions that I know have, they tend to be a little bit more kind of, I don't want to say Shakespearean text, but they're certainly not expressed in, we'll take a $50 million hit for innovation. You know what I mean? It seems like there's maybe a divide there where they can almost get away with saying that they want to be innovative while not really having the mojo to do it.
Right. And you take that like another one that's very common right now is everything around deposit account opening, right? So this is a really common topic that we deal with, which is, let's talk about the workflow and how either the friction that is in opening a deposit account. Obviously, Chime's figured it out, right? They went from 0 to like 13 million users in the course of just a few years, right? Robinhood obviously figured it out. Capital One, I think, has figured it out. And a lot of them are figured it out. But you still walk into many regional and community financial institutions, and the product and consumer experience is being driven by the compliance department, who says, well, the way I read this reg is, you got to prove that all 3 documents in the disclosures were opened and read, and they have to, sign off on them separately. And I need a, drop of blood, and I need, I need a scanned image of the driver's license, and then I have to have someone review it, and then they have to do this. They have to make a call, and they have to, you do that, and it says, well, no one's going to open an account with you whenever they can walk down the street to 5 other places that have figured this thing out, that in 5 minutes or less they can have it done, and the money's in there tomorrow, and they can start transacting. So I think that one is probably the next big one where people say, I want to be really innovative. But then when you say, okay, here's an experience that allows you to open up an account in 5 minutes and get a new customer. I say, whoa, what if it's a fraudster? Oh no, I got to look at every single one of these. I got to run it through my process, right? And say, okay, well then, you can look at the ones that are moving and the ones that are really disrupting the market and getting more than their fair share of the growth. But if you're not wanting to take some of the same chances they've taken, don't expect some of the same results.
Can I ask a question on that? So that's interesting. I know, Ron, you've done some research maybe on Chime. The argument I always get from bank CEOs is, are they getting the customers we would want, right? Does that make sense? Is Chime has opened millions of accounts, but are they the people that our bankers want and are going after, right? The profile. It's just a question. I don't know the answer, but I was wondering if anyone here knows or has done the research.
Problem with that, in answering that, Kathleen, is you've got to go back and ask that bank executive or credit union executive, who are the customers or members you want? And often they don't really have a good answer for that. Right. And I hope they never ask me, because I'll be my last meeting in that institution when I tell them, sorry, but all the 73-year-olds with $7 million in the bank have already been taken. And so if that's who you want, no, Chime's not getting them, but Chime's getting the customers they want, who are low to middle income consumers who meet their product needs and who become very loyal to them because they get early access to the paycheck, and then they start, they're going after that customer. So they're getting the customers they want with that approach, not the ones you want.
Yeah,
that's a great point. It's just, remember when we started online account opening, whatever it was, a couple decades ago, it would be mostly underbanked or people trying to have a new account because their other one got closed, right? So it's always a subject that comes up. So it's a good conversation to have.
I would say that, I would look at it very differently than that. We only use Chime as an example. Whether or not you want the same customers that Chime has is really irrelevant to the topic of the user experience to be able to open an account. Because, and we've had this argument with customers for years, and they said, well, what about our 60-year-olds? What about our 30-year-olds? What about our 16-year-olds? And I go, okay, so show me the different experience that a 16-year-old versus a 60-year-old has with iTunes, has with Google, has with Facebook, now Meta, none of them. So this idea that there's this special demographic out there and they really love to come into the branch and they love a long multi-day process to open up a new account. And those are the people we want. Those people don't exist. So really what everyone wants is convenience. And all I was using it to bring up the example of Chime is just an example of how there's no way that any business, or definitely a financial institution, could have grown to 13 million customers in just a couple of years if they depended upon the same way to start a relationship that pretty much every financial institution in our country depends on to start a relationship. It would have been impossible. And so all I was just saying is that they've proven that you can grow and like I said, get more than your fair share of the market if you'll create a low friction, intuitive user experience that makes it easy for people to become your customer. And that's generally not the mindset that most financial institutions have taken, regardless of the customer base that you want. I would say that people that have money want just as much convenience, if maybe not more, than people that don't have as much money. So I would say that I don't think it's a demographic thing. I think it's a user experience thing. And we all love great, simple user experiences. Just look at the phones.
Well, yeah. And even if it is a demographic thing or a little bit of a demographic thing, I think a lot of times, Kathleen, to your point, Chime might get thrown out by a commercial bank because what they're not saying when they ask that question is that they're not really that into consumer. And that the answer to that is, well, what about Square? What about Lending Club? There may have been a time when this was all, I doubt there was, but there may have been a time when this was largely about consumer. But this is about all sectors now. I mean, Rocket did it in mortgage. Chime's doing it in consumer. Square's
Apple with credit card. Apple with credit card. This is pervasive, and I think the bigger problem there, you almost wonder, is what are the questions that you might hear from a bank or an organization that might tell you that the risk appetite or the innovation statement or whatever those are just not in the same ballpark with what they're asking, or they've got somebody chasing, and then I think somebody was asking here, how do smaller community banks find the startup fintechs for potential partnerships? Maybe they have somebody
they have somebody that's supposedly chasing partnerships at the same time that they have an emotion like that, which is a role. I mean, that's a problem, right? Because if you've got supposedly young and ambitious talent chasing, it wouldn't even necessarily have to be young to say ambitious talent chasing potential partnerships internally or externally. And at the same time that you're thinking, I really don't even know if I want those customers. That just seems like a disconnect at the board strategy level.
When I'm out speaking at conferences at ABA or wherever, I always tell like that middle management layer, know who your leadership and your board is, because you can save yourself a lot of frustration. Maybe you're not at the right institution. If you have a strong passion for fintech and innovation, but you're never going to be, if you're just going to be ramming your head into a wall every time you take it to that next level of approval, there's probably not a right fit. And there's a bank out there that does want that innovation, right? And you can go, partner with them. When I was the VP of e-services, so my job was to buy the technology, I will say I helped my compliance officer. She had been with the bank over 40 years. And I would read the regs of anything I was trying to do myself. And it was boring and it was hard and I would fall asleep during it and have to restart the next day. But I read the regs so I could come to her and say intelligently, hey, I've read through this. This is how I see this. This is how someone else sees this. I think we can do it. And she would say, thank you. Okay, great. Let's try it. So I really viewed it as my job, not just hers, to know what I was trying to do and to partner to get things across the finish line. Right. And that really helped in my institution to actually be able to take those steps forward.
Yeah. Pushing the envelope obviously is key to any kind of business and success, right? When you go into an established market, that's why they call them disruptors. You're disrupting the way it's always been done. And I think that really all that we would say we would be challenging for challenging to the regional and community financial institutions is, look, let's look at the numbers. What was it? 40 years ago, there were 30,000 financial institutions. 20 years ago, there were 20,000 of them. Now there's 10,000 of them. I mean, look at that trend. And it's not because, the rules have changed so much. It's just that it's going to be harder and harder to be successful in this. And technology is probably one of the biggest changes. I mean, whether they be mega banks or the fintechs who have a national reach, because as long as you can go to the app store and download their app, you can become a customer. I mean, that is the biggest change in the game. And if you think you can kind of sit back and do things the way you've done and say, well, whoever it was in compliance says that, well, they don't think the reg reads that way. And they're like, okay, so do you have different regs than the compliance officer at Capital One? I mean, so you've got to be willing to push the envelope a little bit, as opposed to reading it in the most conservative manner. You've got to say, tell me the most I can do without absolutely crossing the line. But if you're viewing those things in black and white, it's probably, you're probably living on borrowed time as a financial institution.
Absolutely. And someone I think asked the question, where do you find folks? So that's a great question. I know there's several, but we publish a B2B infographic, right? If once you figure out who your bank is and where you want to innovate and where you're going to focus your time, there is a fintech out there or a legacy that's innovating in your area, right? So there is someone, if you decide account opening is what you're going after and changing that, there is someone doing that awesome, or several someones.
I've seen that too, Kathleen. I think one of the things, if I recall correctly, that I saw you talking about was the idea of, who's a friend versus who's an enemy versus maybe who's a frenemy or whatever. And I know that's something that people are just trying to navigate, which is, I could go work with these people where they're going to come after me. And at a certain point, you just sort of you got to get in there, right?
Yep. And that's why we published it, because most infographics have the B2C folks, right? The Chimes of the world, who are doing a great job. I respect what they're doing. But as a banker, it's nice to go, wait, how can I mirror that experience? Who's working with me? And so folks like Steven's team, right? There's others that are innovating that you can partner with. I think there was an old school mentality. I mean, I know our core, who shall remain nameless, started with an F. We viewed them as the enemy, right? And they were always annoying and driving us crazy and holding us back. I think that has to change, right? That partnership, to be able to call on Steven's team and go, hey, this is what we're working on. Who do you know? Or does Alkami do this? Or does someone partner with Alkami who can help us in this area?
Kathleen, that was a pretty obscure reference. You said core started with the F, and as I went through the Big Four, I was like, "Wow, that was really obsure." Really,
she didn't mean the brand name started with F. She meant what they called them started with F. Hey, listen, there was another question that came in since we're on the topic of fintech and innovation and finding people to partner with or whatever. Grant asked the question about community development financial institutions, CDFIs. And if you guys had any thoughts on that, or Ron, if you had any, I really don't, but.
Well, sure. I mean, it's fantastic to be a CDFI. I don't think it's necessarily easy to become one, but I think, and especially with things like financial wellness, or quite honestly, like I think Ron mentioned earlier, kind of some of the things that Chime does with giving early advanced access to paycheck and things like that. Those are kind of right up the alley of what CDFIs do. So we believe in them. I mean, obviously the credit union space is kind of almost like honorary CDFIs in terms of you look at their mission and kind of what they do, and especially the ones that are designated low income. But I think that they obviously do a service for Americans. So if you're asking, I'm for them.
Well, yeah. I was mainly just since they have lower regulation. I get you get the benefit if you are one, you have more
flexibility. You have more flexibility. Yeah, in your underwriting, your reserve requirements and things like that. So yeah, you can kind of be a bit more flexible on kind of who you bank and some of those types of things. But so I do think in certain ways that does allow them to push the envelope a little bit. Generally, also, especially if they're not dealing with a bunch of losses, they're generally charging higher interest rates, for some of their products, and so they're actually kind of making money on loans, maybe a bit more so as long as they're not dealing with defaults. So yeah, they can be a great source for a lot of innovation because they generally have. I know of one in the Northeast that's actually doing a lot of really neat things. I'm not really familiar with Quantic Bank, but they're doing a lot of really neat things. They were actually one of the first ones, I think, to roll out Bitcoin-based kind of savings rebates, right? So they do a lot of really cool things for their community base. Focus a lot on mortgages and checking accounts. But I do think that they can be very innovative.
Funny, I would think that a lot of the CDFIs would be magnets for a lot of the fintech startups who talk a lot about, financial inclusion and helping. So if they're looking for bank partners, it would seem to me like CDFIs would be the places that they would seek out.
Yeah,
there are peeps at Plinqit for sure.
Yeah, for sure.
Well, if nothing else, I mean, I think one of the things that kind of go back to the whole boardroom strategy thing that jumps out at me is, we talked about, you say you're innovative, but what's your risk statement really? What's your true risk appetite? I think the other thing is, you say you're focused, but if you don't have a specific mission or target market or niche group, it's more difficult to keep on mission because it's like you're chasing financials and lines of business and all this other stuff that you can kind of lose your core. Like I don't want to say you lose your soul, but it's more difficult to keep trying to find your soul. But if you're a CDFI or someone that is very focused on a niche segment for some reason, it seems like don't you think it's easier to just keep your bearings constantly on what you're trying to do and innovations to basically just finding pain points and crushing it?
I don't know if CDFIs have it easier or harder, but I do think as an industry, and we talked about this a bit before, there's a bit of an echo chamber that happens in our industry. We do chase the bright and shiny object, right? Again, crypto is kind of taken over the conversation in our Twitter and our LinkedIn, right? And so we all feed each other on the crypto aspect. Meanwhile, I tried to add an account to my bank, and I can get several different places, right? Because I always like to know what tech's going on. At my large institution, I could add that accountant in 2 clicks. At my community institution, I had to call like I was a brand new customer. Actually, I had to physically call. They called me back the next day and they said to add this accountant to my business account. They were going to email me a PDF. I needed to print it. It wasn't even a fillable PDF. Print it, fill it out, scan it, and then email it back to them. So again, I get that crypto's exciting. I get that that's something we need to be focused on. There's a great audience for it. But there are things like that happening in our community banks that we could fix tomorrow, right? We could digitize that, fix the experience do those things tomorrow. We're just not, right? Because we get so excited about this new thing that's going to change everything that we're not just looking at simple processes that can make us have such a better digital experience.
Well, Kathleen, I would just tell you, you need to bank with an Alkami client, and you would have been able to do all that yourself with our shared access feature. That'd have been no problem. So that's my only plug there. I would say, and I'll give you a list of about 180 of them you can choose from. So, but I would tell you, I think I don't, I've come around on the crypto thing. I would say that I used to like just totally not be a believer in it. Thought it was just some kind of weird thing off there for people that just had too much money. What we've seen though is obviously the interest in it, the actual adoption of it, even as an investment hedge against inflation or as an alternative to gold. Obviously, you see third-party countries. I think it was El Salvador that actually, basically legalized it as a form of currency for all transactions. Crypto is, I believe, here to stay. And here to stay could be for 5 years, could be forever. I think it would be irresponsible for clients to not dip their toe in the water. And even if the initial stuff is like the offering that Alkami and others have partnered with NYDIG to offer, which is a custodian service. But, when you think about more of a global economy, you're thinking about kind of the stabilizations of various currencies. I think crypto is something that if regional and community financial institutions do not get on board and get familiar with, that it's something that could leave them in the dust pretty quickly, quite honestly. And it's amazing when you look at the stats. I mean, I was blown away that when PayPal and Venmo offered this in their app, that within 30 days, 17% of their entire user base had bought crypto with it. I mean, that's pretty big. And I'm one of those 17%, by the way. I don't have a lot of crypto, just full disclosure, like $200 worth. So I'm not like a huge believer like for myself, but what I'm saying is in the market, it is amazing. And you look at some of the transaction volumes and everything that's there. So I'm probably dipping my toe a bit more and more into the water, but you look at PayPal, Venmo, you look at Robinhood's financial filings, how much of their revenue comes from that. Obviously Coinbase, huge company, all based on crypto. So I think that the community financial institution market would be foolish to not get involved with this, because if they don't, it is going to run away from them very, very quickly. Because I think the mega banks it's just imminent that the mega banks are going to be offering this to their customers.
Yeah, we surveyed consumers at the end of last year, found that about 15% of U.S. consumers said they held some form of cryptocurrency. And I forget the exact percentage, but I think it was pretty close to half or more who said they'd want to get it from their banks. Mm-hmm. And yet when we surveyed banks and said, what are your plans to get into cryptocurrency? I think it was low single digit. Now, that was last year. I'm looking forward to this year when we run the What's Going On survey to see if there's any change in that. But I'll tell you what kills me about that is how many bankers you talk to that say, we're customer centric. We listen to the voice of the customer. Well, your customer is saying they want crypto from you. So where are you on that? Mm-hmm. But they've got many reasons why they don't want to get into it. The risk, and not their risk, but the customer risk aspect of it.
Yeah.
They're like, okay, but you allow them to purchase stocks that have dropped like 90% in value over the past year. So why wouldn't you let them buy cryptocurrency? The logic and the arguments don't kind of hold up, but the emotions are there. And the whole crypto arguments become sort of the new big debate. Used to be, are banks dead? Now the new debate is, should we get into crypto?
Yeah. Well, and I don't know if you saw that. I think it was PayPal. Was it today that just announced a high yield savings account, for their customers now? So, what used to just be just what you used to pay each other, right? And then now you can buy and sell crypto within the solution. Oh, by the way, you don't need to transfer that money back into your bank. You can actually have a high yield savings account here with PayPal. So if you're not seeing what they're doing, they're leveraging these disruptive products to pique people's curiosity. If you don't offer them, then they do a little bit of business with this company. And then now that company is such a great experience and it was so easy. And boy, this isn't like my traditional bank or credit union. And then, all of a sudden now they're offering me a 3% APR on a savings account. Wow, there's no way I could get that from my bank. Yeah, because what they're doing is they know they can fund part of that with their crypto transaction fees. So, I mean, you usually have to think about
it's a continuum. I mean, I'll just use we always like to use examples, personal examples. My son, who's a sophomore in school, he uses his Robinhood app. He's always kind of pinging it, and one of his comments was, "Hey, why doesn't my bank's app work like this?" And then his next question was, and what are we getting paid on this savings account, on my money? Of course, I had to tell him it really wasn't his money. But that's a different it's a different problem. But I guess the point is that it starts early, right? So and then the next question is if you're looking to hire young talent into your bank or credit union, if you don't have that kind of thing as a service, are you even going to seem appealing or relevant to them as a potential employee? Which seems like a lot of people are struggling with right now. Which is, does your nephew or niece think? That's always the means test for me. Does my son or my nephew or my niece, if they came to me and said, "Hey, should I go take a job at my bank? Should I do it?" I mean, that's kind of a tough question, right? Because really, this is about, should they go work for a private equity firm? Should they go work for a fintech firm, or should they work for a bank or credit union? It always depends, but I don't know if you guys have a.
Well, think about this. Think about how hot fintech is. Over the last few years, that's something like $30 billion invested into fintech. And so what you would think is if the financial institution was viewed as the innovator as part of in the fintech, right? You would be thinking that you would have all kinds of tech talent flocking to banks and credit unions because fintech is hot. But instead they're not. If anything, they're leaving. So why is it that the perception is if you want to be in innovation, you have to go work for a fintech software company, but you don't go work for the bank or the credit union because they're not really innovative, right? That shouldn't be the way it is. And we're seeing this happen even more so. I mean, in the major metropolitan areas, of course, where you have lots of big tech kind of headquarters and things like that, it kind of made more sense that, hey, if you're living, let's say, the Silicon Valley area, it may be tough for a credit union or a bank there to attract a lot of talent whenever Apple and Google and Facebook and everyone else is just right down the street. But what we saw, especially in the Midwest and in other kind of parts of the country, if you were in Kansas or Iowa or Alabama or whatever, you could bring in some pretty great IT talent, cybersecurity talent, dev talent, because there are really not other options. Well, now with this whole work from anywhere mindset, now people in pick it, Alabama, Tennessee, Kansas, whatever, now they're working for Apple, they're working for Google, they're working for Facebook from their house. And what we're seeing from even some of our clients is that dev team they had put together, they're starting to leave because they're getting these really lucrative jobs with high tech companies working there. So I think that it's really incumbent upon the financial institution to your point, Sam, to develop a brand of this is where innovation happens, and you're going to want to come and be here, and you can be an innovative technology professional working at a financial institution because the two are synonymous.
Yeah. And I think, Stephen, I agree with you. And I do own crypto, so I'm not anti-crypto or not into it. But I do think you have to be from front to back, right? You can't go out and offer crypto and say we're innovative and attract the best talent, right? You can't just do that one checkbox because the industry is saying this is easy to turn on. Let's turn it on. Those same folks that want crypto also want to be able to bring their own device, and we have not figured that out. Or they want to be able to use, Apple computers in a bank. They want to not have something that's one step above, DOS system, right? That they're using to do transactions at the teller window. So there's a lot of things as banks and regional and community institutions that we need to do to make the work experience better from front to back. And then crypto makes sense, right? And then right, okay, yeah, that's a piece of the strategy to become innovative, but I just don't like when we focus on the bright and shiny and something we can switch on easily that then doesn't match anything else that we're doing.
Yeah, that's a good point. Yeah, and I would say that generally speaking, and we have some really innovative clients with the things that we're describing, they're doing it. So if they were watching this, they'd be like, hey, wait a minute. But I would say they're the exception, not the rule. Yeah. That most financial institutions are not considered progressive, high-tech companies. And that's what doesn't match is that you'll hear them say things like, hey, we're really a technology company that sells financial products. But really, if you were to walk their halls and to Kathleen's point, talk about some of their rules or kind of their processes, you'd go, you're not a technology company. you're a bank or you're a credit union that dabbles in technology. And so I do think that is, but what we see happening is that the ones that are winning are the ones that have adopted that mindset.
Yeah, absolutely. And they can do it, right? That's the thing. There they're just this misnomer that these regulations and compliance you can't be that, right? But you actually can. If you dive into actually what's required versus the myths and the stories we've been telling ourselves for the last 30 years, you actually can get there.
Great.
I actually got a question I want to throw out to you guys, and maybe Stephen, I'll start with you because you kind of referenced the amount of investment going into fintech. So kind of a two-part question. Number one, do you see that continuing? And do you see that continuing, especially into neobank challenger banks, or like what I like to call community fintechs? But where do you see that money continuing to grow, and where do you see it going?
Yeah, those are two different investments. I'm glad you kind of made that separation, because we deal a lot, as you can imagine, with private equity, growth equity, VC, institutional investors as well. And so there are people that kind of look at various kind of thesis around kind of, or they have kind of their target kind of investment vehicle. I would say that I'll talk about the neobanks first. I will say that there's a little bit of a pause that we've heard. Now, most of this is anecdotal, right? So it's not like I've pulled 100 of these investors and asked them. So it's just the ones that we deal with. When you look at Chime probably as the most successful one that it's out there, at least that we can think of, at least in the United States. And people are saying, okay, like it almost couldn't have gone any better in terms of their growth. And now they're starting to say, okay, now show me the money and where this actually plays. And now, especially now that they're starting to get some attention of people saying, now, wait a minute, you can't be under the $10 billion threshold forever here, right? So they are starting to question that. And so I think there is a little bit of a pause saying, I don't know that I'm looking for the next Chime, because I'm not even sure if Chime is really going to be, long-term successful, right? So I do think there's a little bit of a pause there. Doesn't mean there's not some people doing some of those things. When it comes to companies like Alkami and others, or let's just say some of the earlier people that are maybe earlier in their stages, along with Alkami, whether it be Plaid or maybe like there's a really cool company called Atomic that's doing some really neat things around, tying into payroll systems and things like that. I do think what you're seeing is that some of the valuations are getting so heady that in terms of valuations, in terms of what the companies or the owners are expecting from an investment for a valuation perspective, that there's been a little bit of a pause. So it's not that there's not a huge appetite to invest, but they're saying not at any price. Whereas for a while, it was almost at any price. They were just chasing the valuation multiples as far up as they would go. We're starting to get to this point where people are saying, yeah, the problem is, you'd have to grow this thing 400% over the next 3 years for me to break even, but if you want me to put in at that valuation. So what we are hearing from at least some of our investors and from others as we're looking, because Alkami obviously looks to acquire as well. We have a war chest, and part of what we're doing is looking to acquire, is that the current investors or owners in some of these companies that would be acquisition or investment targets are, they're really proud of their company, and they're really sure of all the growth that it's going to happen over the next 2 years. And so they want you to pay the price as though it's a guaranteed thing. So we do see a bit of a slowdown to where it's not, I always think of in the auction, you get that part of the auction where at the beginning, everyone's just raising their paddles, and then you start to get to a price to where there's only one or two left. And eventually someone says, enough, no more, I'm not going any higher. And I think we're starting to approach some of that with some of these fintech valuations.
Yeah, absolutely.
What do you think, Kathleen?
I think it's still bananas. Money 2020 felt insane, and it felt like there was just money pouring from the sky. With that said, I would be remiss to not mention my friend Brandon DeWitt from MX who passed this week. And on this topic, I can't not quote him. So just a shout out and thinking about the MX family. But I loved what he said when he was participating in AFT. He was saying what he likes to tell the banks is, what's so great is this VC money is all pouring into the industry, innovating for us, testing things. And then as banks, you're in place to then take it and adopt what works, right? So we can basically use it as a big think tech or lab, right? And then the banks can take the things that actually get through the regulation, that actually work and change the way things function. And I do think that's exciting. And that's where we're getting, because Robinhood, Plaid, others are getting into a lot of trouble because they didn't operate like a bank. And there's fines and there's things happening that those of us in the industry knew would happen. I do think there's a bit of a pullback of, oh, wait, we didn't think about those things, but a lot of good came out of it. A lot of innovation, a lot of pushing the envelope came out of it. And now banks can take those vetted pieces and implement them within their organization, which is really, I think, exciting, right? As long as we move quickly, right? As long as we do it more quickly than maybe we are right now.
Yeah. By the way, I'll second. I don't think I speak on behalf of all of us about Brandon DeWitt. Really appreciate the shout out, Kathleen. And yeah. I know one of the things that Brandon used to talk about, I read somewhere in an interview with him about, the idea of 5-year chunks, that when you're looking at your career or you're looking at accomplishing something in this space, that it's productive to look at things in 5-year increments. That you only have so many. The time is precious, right? You only have so many increments to get this stuff done. And I think is really interesting about what you just said too, is that this stuff happens so fast that there's no sense in even looking out. I think there used to be a time, Ron, in our strategic planning when we would have banking clients that would look out 5-10 years or something. It's like now it's the typical span is maybe 3 years. But the point is, what can we get done? The question that came in here from David about, is there a specific area of crypto? Do we really think that community banks can serve a crypto need, or will people gravitate towards the fintechs? And I guess I would just come back to, I think, Ron, you used the term community fintech, like a niche. Or is there a specific commercial segment or a specific type of customer, not just broad consumer, that, within a 5-year window or a very short period of time, that you could build up a use case around helping that small group with crypto as opposed to, everybody in our zip code? I don't know. It's just something that came out. I don't know if you guys have any sense for what David's saying here around, do you really think that a community bank has a shot?
Yeah, I hear what David's saying, and here's how I feel about it. I think it's something like 90% of folks or 80% of folks still pick their primary financial institution, especially as they get older and their needs get more complex, based on location. And I'm not saying we need branches or those things. So do I think that, fintechs will always win when they're pushing the envelope into this new NFTs or these different things? Yes, I think fintechs are going to win because they're going to be able to move faster there. With that said, my primary relationship and the more complex relationship and the deeper relationship, I still really, truly believe community banks can win, right? Because I need a small business loan and I need things that one fintech isn't going to do. So if a community bank can also then house my crypto for me, even if it's in a simple FBO, I may use the fintech to push the envelope and to go after the new. But then once it's more established, I do think that relationship with the community bank and that core or whatever bank it is important and is a piece of it, right?
Well, I think if you're talking about the stats as far as based on location, if you were to segment out those responses by people under 30, you would see a radical difference between those that care about location versus those that are, let's say, 50 plus. And if you went below 25, I think you almost may have hardly anyone that says based on location. I know my daughters, 21 and 22, their primary financial institution is Venmo. So, and that's just the way
their primary institution is you, Steve. You're the primary.
Well, no. I mean, they work full time and everything else. Like, oh yeah, I've got this account at Wells Fargo. I never log into it. I just log into Mint and Venmo and PayPal. I mean, that's just the way they think, right? So they're like, where is the branch at? I didn't even know there was one. I mean, it was funny showing a 20-year-old what a check was and how to write it because they just never seen it. So I do think it's a little different. But to the question. Yes, I do think that they will go to community banks. I think what you have right now in crypto, but we're right on the edge right now where we're starting to get into kind of the early minority or early majority. You had the early adopters and innovators, and so they went to where they could get it, right? And it was to companies like Coinbase or whatever. What's happening now, though, is it's becoming more mainstream. And then other people are kind of lifting up their heads and saying, yeah, that should probably be part of a diverse portfolio. Like I should probably have something in crypto. And quite honestly, especially with where savings rates are, what good does it do me having the money, sitting there in a savings account? And so the convenience drives so much of consumer behavior. And so it's very convenient for me. If you're a financial institution, I've already got my checking account there. My direct deposit, I got $100 a month that goes automatically to my savings account when we get paid. I'm going to put another $50 into some crypto as well. That's very convenient. I don't have to go open a relationship with Coinbase. I don't have to open a relationship with Robinhood to do that. So I would just say that if you don't, what happens is the exact opposite, which is all of a sudden now the crypto is as the foot in the door for the competitor. And now they say, hey, by the way, you know how easy that was to do crypto? It's just as easy to do a checking account with us, quite honestly. You go, oh, that's a good point. Now let me just move over there. So even if you don't look at it as a growth play, if you look at it strictly as a defensive move, you need to do it, because the more it gains mainstream, then people say, well, where can I get it? And if they say, oh, my ABC bank doesn't offer it, I guess I have to go somewhere else. Wow. And then when they go somewhere else and they see how easy it was to become a customer of that other place, they're going to start saying, man, why aren't all my accounts this easy? Right? It'll be quick. I mean, Blockbuster thought they had time. They thought they had time because they were making a lot of money. And it was just amazing how fast Netflix just
get your revenue poached. And in the spirit of that, you're talking about, whether it's you mentioned young people getting lured away and then it's gone. Let's follow that. We were talking earlier about talent and getting people like in the community bank and people. Let me just ask you guys, kind of hard segue here. We've been reading a lot about this great resignation and the war for talent. We've talked a lot about the banks, but let's talk about you guys. Are you guys finding it more difficult to recruit and retain talent right now? Are you seeing that on a personal level, or is it?
I think the salaries and stuff are just a bit, they're just insane, right? With the VC money and the flood that's come in, and the fact we have to compete nationally. I just had a team member that got poached for twice. Literally they doubled everything, right? They doubled everything. Again, it's an interesting market. It's an interesting time with all the money flooding into our industry that it is competitive. It's a competitive market, but I don't feel the same as my husband that's in the restaurant business and literally cannot get anyone, right? I don't quite feel like that, but I do. Right. I definitely think that fintechs and banks need to be aware of what comp looks like today and stop thinking of what they made at 35 or 30 or 22 and just know what the market is, right? And compete on where the market is, which is a bit bananas right now.
Kathleen, it's funny you brought up your husband in the restaurant business. So I remember when the chairman of our board said something. He had some statement he made years ago, and he said, you can tell how, just stuck with me. He said, you can tell how well the economy is doing by the quality of the wait staff. So he said, if your waiter or waitress is really good, economy's not doing really well. Because he said when it's doing really well, those people that are really sharp and they're good socially and they're on it and everything else, they've got much higher paying jobs. And so it's just kind of funny. It's just kind of a funny way to kind of measure like the strength of the economy and the job market is like by your wait staff and how good a service you get.
Yeah, I like it.
It's just an interesting thing.
In Michigan. It is rough in Michigan.
Yeah. And so for sure, Sam, we've got like around, I think it's we've got 680 alchemists. And so, we were used to a turnover rate somewhere in the, total turnover, obviously voluntary and involuntary, somewhere in the single digits, kind of in the 6 to 8% range. We put a lot of time into our employer brand and making it a great place to work. We have a ton of great benefits. We have benefits of companies that are 10 times our size. And so we always really, kind of pride ourselves upon that and kind of what we offered to the Alchemist in terms of the benefits and kind of the place to work. I think ours is around 14 to 15% this year, and which we were feeling really bad. Like, what are we doing wrong? And now then when we started to see the industry reports coming, that in the high tech sector, it's 24% is the average turnover rate. With it still didn't, we don't like it. It made us feel better about our relative position to it. But we can just imagine what companies are dealing with that, you got 100 employees and 25 of them left this year. That's huge. And to Kathleen's, to the other point, she talks about, certain companies can't afford to even match a 50%, 100% type of, a counter offer. And so they just really have to say, I don't know. I don't know what to do. Maybe I can't fill that position. And for us, it's a little bit different because we map to certain kind of comp levels, and we use third parties for this to kind of level these things to ensure they're there. But we have seen exactly what Kathleen has seen. There are certain jobs, whether it be maybe it's AWS security engineer. Well, gosh, that thing has doubled over the last couple of years. Or maybe it's a software architect or whatever. And so there are certain jobs that you have seen just an incredible rise in kind of what you have to pay in order to get these people and then in order to retain them. The other thing I would say that is just another byproduct of that is that it used to be where we could just count that, hey, if we have a rec that we need to fill, within 3 weeks, we'll have that rec filled. Like we're in Dallas, we have obviously a huge employee potential resource base here, and we're constantly have candidate flow. Well, now that's like doubled and in some cases tripled. So now whenever someone does leave, what you thought within 30 days you'd have them replaced with somebody in the seat, well, now maybe that's 60 days before you have that. And so you have to factor that into all of your capacity models and everything because it's harder to get them.
It's just an incremental forecast thing.
Yeah,
it's incremental. And I guess one other thing, and I'm noticing here, Ron, that we're about 4 minutes until the top of the hour. We want to be mindful of everybody's schedules, but this is the first FinTech Hustle that we've had where I believe both of our guests are founders. And I guess one quick question I had: any lessons learned, good or bad or ugly, from being a founder? And I don't know, whoever wants to go first.
I just will echo what Steven said earlier. The same experience he had with the NIDIG launch is the experience I see a lot of, including myself, fintech founders have. You go around to your banker friends and you say, I'm going to do this thing. Would you buy it? And they all say yes anecdotally, but that is very different from them actually buying it and you actually getting your first revenue and your first contract. So anecdotal people supporting you going and founding a company is very different than the grit it takes once you're inside of it.
Yeah. I would share two things from a founder's perspective for other potential founders out there. And I share these whenever I'm asked kind of this similar question. There's a saying in kind of the investment community, if you're like an angel or venture investor or something like that, and they'll say, whatever they tell you they need in terms of finances, triple it, because that's what they're really going to need, because they'll always underestimate how much money they'll need to do it. And I would basically take that same statement and say, if you are a founder, whatever you think it's going to take in order to be successful in your company, however many hours, however much time away from the family, however much travel, however much sorrow and failures, triple it, and then decide whether or not you are really ready to sign up for that journey. So that'd be the first thing I would say is, just like an investor needs to triple their estimate, you need to triple your estimate of the commitment and the sacrifice you're going to make. The second thing I would say to everyone, this could be for any company or a founder or not, especially from a leadership perspective, is as tempting as it may be, and especially with this backdrop of the Great Resignation and employee turnover and harder to get talent, whatever you do, do not fall subject to the temptation of compromising your culture. It will always be better to leave that seat empty for longer than to put people in it that are not aligned with your culture. They can become a toxic, a corrosive force within your organization. They set the wrong example for what you actually. They basically send a message to everyone else in the organization about how important culture is. And it's so easy to do. And I see companies do it, and we're tempted to do it at times because, gosh, we could just hire them so quickly and get them in the seat and be productive. But I would just tell you that, we've learned that lesson the hard way in the past whenever we were trying to solve for a timeline. And I will just tell you that, it takes some of those hard lessons to where you say never again. So I would just, if anyone's dealing with some of those potential struggles right now and thinking about that and saying, I like them, they'd be good, but I don't know if they'd fit in here. I don't think it'd be good for our culture. Don't do it. You'll always regret it later.
Well, I appreciate it, guys. Thanks again, Kathleen and Steven, for joining Ron and I on the FinTech Hustle. It's been a pleasure.
Thank you.
Thanks for having us.